When people watch news coverage of the current conflict in the Middle East, the images are usually the same. Missiles crossing the night sky, air defense systems firing interceptors, political leaders delivering statements about security and retaliation. From the outside, it appears to be a conventional military confrontation. But in geopolitics, the events you can see are often only the surface of a much deeper story. Behind the visible fighting lies a much larger system that shapes global power, the structure of the international financial order. For more than half a century, one particular arrangement has helped place the United States at the center of the global economy. That arrangement links energy markets, international trade, and the US dollar in a way that gives Washington extraordinary financial influence. This system is commonly known as the petrodollar system. It is not widely discussed in daily news coverage, yet it plays a crucial role in how global money flows. Because oil is the most widely traded strategic resource in the world, the currency used to buy it carries enormous influence. For decades, most international oil transactions have been conducted in US dollars. That single fact has created constant global demand for American currency. The conflict unfolding today intersects directly with that structure. To understand why this war matters far beyond the battlefield, we first need to step back from the explosions and examine the deeper mechanisms of power that sit underneath them. When conflicts erupt in the Middle East, the explanations that dominate headlines often focus on religion, ideology, or long-standing political rivalries. These factors are certainly part of the story. Historical grievances, regional competition, and security fears all shape how governments act. But those explanations alone rarely explain why a conflict happens at a specific moment in time. In geopolitics, timing usually reveals something deeper. Wars often emerge when large strategic systems begin to experience pressure. These systems can include trade routes, financial networks, military alliances, or energy supply chains. When one of those structures starts to weaken or face new challenges, tensions between states can escalate rapidly. That is why analysts often look beyond immediate events like missile strikes or political statements. Instead, they examine incentives, economic interests, and structural changes in the global system. Energy markets are one of the most important of these structures. Modern economies depend heavily on reliable energy supply, and the routes that move that energy across the world have enormous geopolitical value. Control over these systems influences trade, currency stability, and international alliances. The current conflict intersects with several of these pressures at once. It sits at the crossroads of global energy supply, regional security, and the international financial order. To understand why that combination matters, we first need to examine a broader question. What actually sustains the power of a global superpower over long periods of time? When people think about global power, the first thing that usually comes to mind is military strength. Aircraft carriers, advanced fighter jets, missile defense systems, and large standing armies are often seen as the main indicators of dominance. Military capability certainly matters. It shapes deterrence, alliances, and the ability to project force across regions. But history shows that military strength alone has never been enough to sustain a global power for long. Every long-lasting power has depended on a strong economic foundation behind its military reach. The British Empire, for example, maintained influence not only through naval strength, but also through control of global trade routes and financial institutions. London became the center of international finance during the 19th century, giving Britain enormous economic leverage. The same pattern appears in the modern era. The United States possesses the most advanced military in the world, but that military is supported by a vast economic system. Financial markets, global trade networks, and international investment flows all reinforce American influence. These structures allow the country to fund large defense budgets and maintain global alliances. In other words, military power is the visible layer. Economic power is the engine that keeps it running. Understanding that relationship is essential for understanding today's geopolitical tensions. Because in the case of the United States, one particular economic mechanism has played an unusually large role in sustaining that system. And that mechanism is closely tied to the global oil market. Oil remains one of the most important commodities in the global economy. It fuels transportation, supports manufacturing, powers military logistics, and drives international trade. Even as renewable energy expands, oil still plays a central role in modern economic activity. Because of that importance, the currency used to buy and sell oil has enormous influence over global finance. For more than 5 decades, the majority of international oil transactions have been conducted in US dollars. This arrangement is often referred to as the petrodollar system. The mechanics are relatively simple, but extremely powerful. When countries need to import oil, they usually need US dollars to complete those purchases. That means governments and central banks around the world maintain large reserves of dollars in order to participate in energy markets. Banks, corporations, and traders also rely on dollar-based financial networks to handle oil payments. The result is a continuous global demand for the American currency. This demand strengthens the role of the dollar as the dominant reserve currency in international finance. Countries hold dollars not only to trade energy, but also to stabilize their own currencies and manage international transactions. Over time, this system created a feedback loop. The more the dollar was used in energy markets, the more central it became to global finance. But this arrangement did not simply appear naturally. It developed through specific geopolitical relationships, particularly between the United States and the oil-producing states of the Persian Gulf. And that relationship would become a key pillar of the modern international system. The global demand for dollars created by oil trade produced a set of advantages that few countries in history have enjoyed. Because so many governments and financial institutions hold dollars, the United States is able to borrow money more easily and often at lower interest rates than other countries. Investors around the world are willing to hold US government debt because the dollar is widely trusted and used in international transactions. This steady demand for dollar-denominated assets gives the United States considerable financial flexibility. It allows Washington to run large budget deficits while still attracting global investment. It supports deep financial markets that channel capital through American institutions, and it helps maintain the scale of economic activity required to sustain a large global military presence. Reserve currency status also shapes international influence in other ways. Countries that rely heavily on the dollar system often operate within financial networks that pass through American banks and payment systems. That gives the United States leverage through sanctions, regulatory oversight, and financial policy. In effect, the dollar does more than function as a currency. It acts as an organizing center for a large portion of global finance. But this system did not develop by accident. It emerged from specific strategic agreements during the 1970s, when the United States and key oil-producing states in the Persian Gulf formed a partnership that linked energy markets to American security guarantees. The foundations of the modern petrodollar system took shape during a period of major change in global energy markets. In the early 1970s, oil prices rose sharply, and energy-producing states in the Middle East gained unprecedented economic influence. At the same time, the United States was navigating a shift away from the gold-backed monetary system that had previously anchored the international financial order. In that environment, Washington pursued a strategic partnership with major oil exporters in the Persian Gulf, particularly Saudi Arabia. The arrangement that emerged was relatively straightforward in principle. Gulf states would continue selling oil primarily in US dollars, reinforcing the currency's central role in global trade. In return, the United States would provide military protection, security cooperation, and access to advanced defense technology. This relationship aligned the interests of both sides. Oil producers benefited from security guarantees that helped protect their infrastructure and political stability. The United States benefited from a financial system that ensured global demand for its currency. Over time, this partnership expanded to include other Gulf states such as the United Arab Emirates, Qatar, Kuwait, and Bahrain. American military bases and security cooperation became a central feature of the region. The result was a powerful combination of energy, finance, and security. As long as the Gulf region remained stable and oil continued to be traded primarily in dollars, the broader system supporting American economic influence remained intact. But that stability is precisely what the current conflict is beginning to test. When most people follow developments in the Middle East, their attention usually focuses on the most visible flashpoints. They watch the fighting between Israel and its adversaries, the missile exchanges, and the political statements that dominate international headlines. But in strategic terms, the most important region in this conflict may lie slightly farther east. The Persian Gulf sits at the center of the global energy system. Countries such as Saudi Arabia, the United Arab Emirates, Qatar, Kuwait, and Bahrain are among the world's most important oil and gas producers. Their exports power industries across Asia, Europe, and beyond. Because of this role, the Gulf is not just an energy hub, it is also a financial hub tied directly to the global dollar system. Revenue from oil exports flows into international investment funds, sovereign wealth funds, and global financial markets. Large portions of those transactions move through dollar-based systems. The stability of Gulf economies therefore reinforces both energy supply and the broader financial structures connected to it. That is why disruptions in this region can have consequences far beyond local politics. When tensions rise in the Gulf, energy prices react almost immediately. Investors begin reassessing risk. Shipping companies monitor maritime security more closely. governments consider contingency plans for supply disruptions. In other words, the Gulf is more than a regional theater of conflict. It is a central pillar of the global economic architecture built around energy and finance, and that makes stability in the region a strategic priority for many countries. The prosperity of many Gulf states depends not only on natural resources, but also on a broader reputation for stability. Over the past few decades, cities such as Dubai, Doha, and Abu Dhabi have positioned themselves as international financial and commercial centers. They attract multinational corporations, global investors, and millions of expatriate workers who support their growing economies. This transformation did not happen by accident. It relied on a perception that the Gulf region was relatively secure compared with other parts of the Middle East. Large infrastructure projects, financial districts, and tourism industries all developed under the assumption that regional stability would continue. Investor confidence plays a crucial role in that model. When investors believe a region is safe, capital flows into property markets, technology sectors, logistics hubs, and financial services. International firms open offices, establish regional headquarters, and expand long-term operations. But confidence can be sensitive to geopolitical shocks. If investors begin to see a region as unpredictable or vulnerable to repeated attacks, the calculations change. Insurance costs increase, investment projects slow down, and companies reconsider expansion plans. Even limited military incidents can influence how markets evaluate risk. This dynamic means that security threats do not need to destroy infrastructure to have economic consequences. Sometimes the mere perception of instability can begin shifting financial behavior, and that possibility forms part of the strategic environment surrounding the current conflict. In conventional military terms, Iran faces a clear imbalance when compared with the United States and its closest allies. American forces possess advanced air power, global logistics networks, and one of the most technologically sophisticated militaries ever assembled. Iranian strategists are fully aware of that gap. Because of this, Iran's regional strategy has rarely been based on defeating the United States in a direct conventional confrontation. Instead, it has focused on methods that apply pressure to the broader system supporting American influence. One part of that strategy involves the use of asymmetric capabilities. These include drones, missiles, naval harassment tactics, and relationships with regional non-state actors. Such tools allow Iran to challenge stronger opponents without matching them aircraft for aircraft or ship for ship. Another element involves geography and economic leverage. By operating near critical energy infrastructure and shipping lanes, Iran can influence areas that are central to global energy supply. Even limited disruptions can raise shipping costs, increase insurance premiums, and cause volatility in oil markets. From Tehran's perspective, these actions do not need to defeat an opponent militarily to have strategic impact. Instead, the goal is often to increase the overall cost of confrontation. If regional instability grows, the resulting economic pressure can ripple outward through energy markets, financial systems, and diplomatic alliances. In that sense, the conflict becomes not only a military contest, but also a struggle over the stability of the broader system that underpins global energy trade. At the center of the Gulf region lies one of the most strategically important waterways in the world, the Strait of Hormuz. This narrow passage connects the Persian Gulf to the open ocean. At its narrowest points, it is only about 50 kilometers wide. Yet through this corridor flows a massive share of the world's energy supply. Estimates suggest that roughly 1/5 of global oil consumption passes through the Strait of Hormuz every day. Tankers carrying crude oil and liquefied natural gas move through this route toward markets in Asia, Europe, and other regions. Because of that concentration of energy shipments, the strait functions as a classic geographic choke point. A choke point is a location where a large volume of trade must pass through a relatively small area. When that happens, even small disruptions can have global consequences. Shipping delays, security threats, or military tensions in such locations can quickly influence energy prices and international trade. The geography surrounding the strait also adds complexity. The northern coastline belongs to Iran, while the southern side includes Oman and the entrance to the wider Gulf region. The proximity of these coastlines means that any military activity near the strait is immediately close to critical shipping lanes. For this reason, tensions in the area are watched closely by energy markets and governments around the world. Control, access, and security in the Strait of Hormuz are not just regional issues. They are factors that can influence the stability of the entire global energy system. Geography often plays a quiet but decisive role in conflicts. Maps determine where armies move, where trade flows, and where infrastructure can be protected or exposed. In the Persian Gulf, geography creates a unique strategic environment. On the southern side of the Gulf lie the major energy producers such as Saudi Arabia, the United Arab Emirates, Qatar, and Kuwait. Much of their critical infrastructure sits across large stretches of relatively flat desert. Oil fields, pipelines, refineries, export terminals, and desalination plants are spread over wide areas that can be difficult to defend completely. Protecting every facility across hundreds of kilometers of open terrain is an enormous challenge, even for countries with advanced air defense systems. Across the water, the geography looks very different. Large sections of Iran's southern coastline are backed by rugged mountain ranges. These natural formations create terrain that is more defensible and harder to monitor. Over time, Iran has built military installations, missile storage facilities, and command structures within these areas. This contrast shapes strategic thinking on both sides. The Gulf states possess enormous financial resources and advanced equipment, but their infrastructure is highly visible and geographically exposed. Iran, meanwhile, operates from terrain that can provide greater concealment and defensive depth. These geographic realities do not determine outcomes on their own. However, they influence how both sides plan operations and how easily certain targets can be protected, and they add another layer of complexity to a conflict already shaped by energy markets and global trade. Another factor shaping modern conflicts is the changing relationship between military technology and cost. For much of the late 20th century, military advantage was closely linked to technological superiority. Countries invested heavily in advanced aircraft, precision-guided weapons, satellite systems, and sophisticated missile defenses. The assumption was that the side with the most advanced technology would maintain a decisive advantage. However, recent conflicts have highlighted a different trend: cost asymmetry. Some modern weapons are relatively inexpensive to produce, but can force opponents to deploy far more expensive defensive systems. Unmanned aerial vehicles, commonly known as drones, are one example. Certain types of drones can be built at comparatively low cost while still carrying explosive payloads capable of damaging infrastructure. Defending against these threats often requires advanced interceptor missiles or air defense systems that cost significantly more. This imbalance can create financial pressure over time. If large numbers of low-cost weapons are deployed repeatedly, the defending side may need to expend far more resources to intercept them. Military planners increasingly recognize that warfare is not only about firepower or technology, it is also about sustainability and economics. The ability to maintain defensive systems, replenish equipment, and support long-term operations can become just as important as initial battlefield performance. And this shift in the economics of warfare is now influencing how countries think about both strategy and deterrence. In international politics, power is not measured only by weapons or economic size. It is also shaped by credibility. Credibility refers to the belief held by allies, rivals, and investors that a country can and will defend its interests when necessary. Over time, this belief becomes a strategic asset. It influences alliances, financial decisions, and diplomatic relationships. For decades, the United States has benefited from a perception that its military capabilities are extremely difficult to challenge directly. This reputation has supported a network of security partnerships across multiple regions, including the Middle East. Countries that align themselves with Washington often do so partly because they believe American military protection can deter threats. That confidence encourages cooperation in areas such as defense agreements, trade, and energy policy. Investor confidence is influenced by similar perceptions. When financial markets believe that a region is protected by strong security guarantees, capital flows more freely. Infrastructure projects move forward, and international companies feel comfortable establishing long-term operations. But credibility is also sensitive to change. If conflicts begin to reveal vulnerabilities or prolonged instability, observers may start reassessing previous assumptions. Governments reconsider alliances, investors review risk exposure, and markets adjust expectations. This does not mean that a single conflict can overturn decades of strategic relationships. However, visible stress on established systems can influence how other states evaluate the reliability of existing security arrangements. And in regions where energy supply and global finance intersect, those perceptions carry particularly large consequences. Modern Gulf economies depend on a vast network of critical infrastructure that supports both daily life and global energy supply. Oil fields, pipelines, export terminals, and shipping facilities form the backbone of the region's energy industry. These installations connect production sites to global markets and allow energy resources to move efficiently across continents. But there is another piece of infrastructure that is just as essential: desalination plants. Much of the Gulf region lies in arid desert environments with very limited natural freshwater sources. Large coastal desalination facilities convert seawater into drinking water for millions of people. In several Gulf countries, these plants provide the majority of the population's freshwater supply. Because of their scale and location, desalination facilities are fixed industrial sites. They require large amounts of energy and operate continuously to support urban populations. This creates a structural vulnerability. Critical infrastructure of this type cannot easily be relocated or concealed. Energy facilities, pipelines, and water systems must remain where geography and logistics allow them to function. Protecting every installation across vast territories can be extremely difficult, even with advanced defensive systems. In strategic terms, this means that economic and civilian infrastructure becomes part of the broader security landscape during regional tensions. Even limited disruptions can have significant effects. Markets respond quickly, insurance costs change, and governments begin planning for contingencies. In complex geopolitical environments, infrastructure stability often becomes as important as battlefield developments. Strategists often use simple models to explain how conflicts escalate. One of the most well-known is called the game of chicken. In this model, two drivers race directly toward each other on the same road. The first driver who turns away avoids the collision but appears weak. If neither driver turns, both crash. The dynamic is uncomfortable but useful for understanding certain geopolitical confrontations. When rival states believe backing down will damage their credibility, they may continue escalating even when the risks are obvious. Each action is intended to demonstrate resolve and signal that they are prepared to endure more pressure than their opponent. In the Middle East, similar dynamics can appear during periods of intense tension. A strike may trigger a retaliatory strike. Each response is often calibrated to avoid full-scale war while still showing strength. Over time, however, these cycles can become increasingly dangerous. The more rounds of escalation occur, the smaller the margin becomes for miscalculation. Leaders make decisions based on assumptions about how the other side will react. They estimate the limits of their opponent's tolerance for risk and attempt to operate just below that threshold. The problem is that those assumptions are not always correct. If both sides believe the other will eventually back down, they may continue pushing forward simultaneously. In that environment, even a small mistake or misunderstanding can rapidly widen a conflict beyond its original scope. Another difficult reality of modern conflict is that military operations do not always produce clear political outcomes. Airstrikes can damage infrastructure, disrupt military capabilities, and place economic pressure on governments. However, history shows that bombing campaigns alone rarely force major political change inside a large and determined state. Countries with significant territory, large populations, and complex political systems often absorb external pressure more effectively than expected. Governments adapt, infrastructure is repaired, and domestic narratives shift to emphasize resilience. Because of this, achieving decisive political objectives through air power alone can be extremely challenging. Ground operations, which involve occupying territory and controlling key areas directly, have historically been the method used to impose lasting political change. But those campaigns carry enormous costs in resources, time, and human lives. In many democratic societies, public support for large ground wars has declined sharply after the long conflicts of the early 21st century. Political leaders must therefore balance military objectives with domestic realities. This creates a strategic dilemma. If air campaigns are unlikely to achieve long-term political change, but ground operations are politically unacceptable, policymakers may find themselves operating with limited options. In such situations, conflicts can settle into prolonged periods of pressure, deterrence, and limited escalation rather than decisive victory, and those drawn-out confrontations can place sustained strain on regional stability and global economic systems. The conflict unfolding in the Middle East is still evolving, and its final outcome remains uncertain. Wars rarely follow the paths that analysts predict in advance. Diplomatic breakthroughs, economic adjustments, or political changes inside key countries can quickly reshape the strategic landscape. However, one thing is already clear. The systems that have structured global power for decades are now experiencing visible stress. For more than 50 years, the petrodollar system helped anchor the United States at the center of global finance. Energy markets, international banking, and geopolitical alliances reinforced one another in a relatively stable framework. As long as confidence in that system remained strong, it continued to reproduce itself. Countries traded oil in dollars, held dollar reserves, and invested in financial markets connected to the same network. But large geopolitical shocks can test that confidence. When conflicts threaten energy routes, when investors question regional stability, and when states begin exploring alternative financial arrangements, the system enters a period of uncertainty. Some countries may experiment with new currency agreements, new energy partnerships, or new regional financial institutions. Whether those changes become permanent is still an open question. Global systems often prove resilient. They adapt, adjust, and survive crises that once appeared threatening. Yet moments like the current one serve as reminders that even long-standing structures are not guaranteed to last forever. And understanding how those systems function may be one of the most important tools for interpreting the world as it continues to change.